Hello and welcome back to another This Week at the Zoo, our weekly news podcast here at Wall Street Petting Zoo. I'm Christopher Smith.
And I'm Robert Coburn.
And this week, Robert, we started off the week Monday and Tuesday with sort of slow days, slow news days. The market inched a little higher on Monday and Tuesday on optimism about trade talks, but it reached a critical resistance level and kind of topped out there.
Yeah, and then Wednesday, the headlines said that the trade talks between U.S. and China had been delayed until December, which caused a small little pullback on the market, but it actually not as much as we expected it to be.
Yeah, I was definitely a little surprised. I actually took my money out of the market on that news that trade talks had been delayed, which sucked for me because pre-market on Thursday, we got some very positive trade news. It was widely reported that the U.S. and China had agreed to mutually remove their tariffs on each other. As you might expect, the market initially surged on the news. I actually bought back into the market early morning and made a little bit of money. But we got some midday pullback, and so I had to exit with very small profit midday. As investors sort of dug into the details of that news and realized that the tariffs not only haven't actually been removed yet, but they're supposed to be removed in phases, and both sides will remove exactly the same amount of tariffs at the same time. And it basically just wasn't a done deal yet. It seemed very vague. Like there was not even the idea that we're both going to remove the same amount of tariffs. Is that proportional, or is that an exact dollar value? Because the two countries may not actually have exactly the same amount of tariffs on each other right now. So there just were a lot of details yet to be worked out, and that hadn't yet been worked out. The most important outcome of that, though, the market rally on Thursday, was that the yield on Treasury bonds increased. For a while now, the yield on Treasury bonds has been below inflation, meaning that if you buy Treasury bonds, you're actually losing money. They call it an inverted yield curve. And that is a really important recession indicator. It's one of the early signs that we may be heading into a recession. And so investors have been really concerned about this inverted yield curve for several months now. Um, but as Treasury yields rose on Thursday and the market rallied, that recession signal went away, which is a really important green light for the market moving forward.
So with treasury bonds, if they would lose you money over time, would that be for investors who are betting against the economy on a whole, like they're betting the dollar is going to be worth less over a greater period of time than if it were to increase?
I mean, basically, if the yield curve is inverted, there's really no reason to be in Treasury bonds. uh, you'd be better off keeping your money in stock. So I don't know why anybody would buy Treasury bonds under those circumstances. But it's a sign that basically um, there's not much confidence in the economy, in the government. So yeah, basically stay out of bonds when there's an inverted yield curve.
So, what stocks were you watching this week?
All right. Well, I was watching Eros. Eros topped out at almost exactly my price target. I think I said last week that I would sell at 258, and I did. And it topped out at 259 before falling back down to 224. So, and then I bought back in with a smaller position, and it's popped back up to the 250s. So my trading plan has worked out almost perfectly on Eros, and I'm going to be watching it for a possible breakout above 260 next week. Analyst ratings and so forth on Eros have been really bullish. We've gotten some very positive articles written about it from Seeking Alpha. So the investor sentiment on Euro seems to be really good right now. And if we break 260, we've definitely got room to run up to $3 fairly quickly. So definitely watching for that. I was also watching oil prices this week, and it was a pretty wild roller coaster ride. If you remember, last week we ended with optimism about a trade deal with China, and oil has a lot of exposure to tariffs. So any news that's optimistic about trade talks causes oil to react positively. And so early this week, it was rising on that optimism. Wednesday, though, we took a hit after the Information Administration published a report showing that U.S. crude inventories have continued to increase a lot faster than expected. So we got a big surprise inventory build on Wednesday. That shows that demand for oil is still weak, and so oil pulled back. And I went into Thursday with a short position on oil, which was bad for me because Thursday morning we got those reports that the U.S. and China had agreed to repeal tariffs. So oil shot up, and my short position I had to get out very quickly and just cut my losses. Um, it Oil weakened a little bit later in the day as investors realized there wasn't actually a deal yet, and also OPEC, the Arab oil consortium, reduced its oil demand forecast for the next year. Maybe it looks like oil is not going to be as much in demand as expected, and so it could over the next year continue to fall. But on Friday, oil shot up again, which was a little bit of a surprise for me. After China published its oil import numbers for October, showing that its imports increased 11.5% in October versus the same month last year. That was the second consecutive month of strong growth, 11% plus growth in China crude oil imports. China's been opening a lot of oil refineries lately, and it's trying to become a dominant player in the refining and energy industry. So strong China demand could help boost those demand numbers for oil and help raise oil prices. And there were also reports Friday that Saudi Arabia is manipulating oil prices upward ahead of the IPO of the Saudi oil company Aramco. This is the biggest IPO in history, the Aramco IPO, but it comes at a time when the outlook for oil is bad. And so the Saudis are really worried that this IPO is going to go really badly. So they've been bullying everyone, twisting the arms of every millionaire or billionaire in their country to get them to invest in Aramco at the IPO. And they're also apparently manipulating oil prices upward. So in the long term, I think oil is a loser. But with these, strong China demand and the Saudis manipulating oil prices, the short-term outlook has improved, and it could rise early next week. We'll see. I'm not really sure what's going to happen early next week, but the next big thing that will move oil will be the inventory numbers next Wednesday, probably.
When if you got every rich person in your country to buy a known loser, wouldn't that just make your entire country broke after the IPO just tanked?
Nobody ever said that dictatorships work efficiently. Yeah, I think that this is probably a pretty bad idea for their economy, but the government has to save face, and they're making a big bet on Aramco, so we'll see how it plays out for them. I wouldn't invest in it myself, that's for sure. CVS, which we've talked about recently, has been on an absolute monster run. Do you have any CVS, Robert?
I don't, but I wish I had.
Yeah, I mean, it killed this week. I think I ended the week up like 7% or something for the week. As green all week. On Friday, it officially broke its downward sloping trend line, meaning that momentum on CVS has officially changed. It's been in a slump for about a year, staying underneath this trend line, and it's now broken that trend line. It's looking overbought. It's gotten, it's moved very fast, and so we might see a bit of a pullback from that trend line. But I think that this is going to keep running in the medium term, and that we will see probably $78 per share within a month or two. And I think within a year or two, we will see $95 per share. This is still a pretty undervalued stock, and it's got a lot of upside potential given their aggressive growth plan. So, the run isn't over for CVS, although we may see a bit of a pullback next week, which would be a great buying opportunity for anybody who wants to get into CVS. And also a quick update on gold. I've been watching gold for a while because, as we've discussed before, the Fed has been trying to weaken the dollar. So they've been doing some what they call quasi-quantitative easing, where they're printing money and trying to inject money into the lending market. They also have been lowering interest rates. We've gotten 3 interest rate cuts this year. I have expected this to weaken the dollar. And that's what the Fed is trying to do, is weaken the dollar. But guess what? They're failing. In fact, some analysts are saying the Fed has totally lost control of inflation. and that the dollar is going to continue to rise. It certainly rose this week on the strength of the market rally. Both the market and the dollar are at resistance levels right now, so the dollar might pull back a little bit next week, or it might keep running. So gold has fallen hard. Gold right now is at a critical support level, and if it breaks below the level that it's at right now, about I think 1258 or something like that, it could plunge. It could absolutely plunge. So gold is actually 1458, I believe, is what it's at right now. But gold is in trouble, and so I have definitely pulled my money out of gold. Um, and I will not be watching gold again for quite some time, I think. One of the things that's going on here is bond rates have normalized, so now all the investors who were in gold in order to protect themselves against a recession are moving not only back into the stocks because the market has broken out, but also into bonds because now there's actually meaningful yields on bonds. So I think that demand for gold is going to be very weak for quite some time to come.
Is that why I don't see cash for gold commercials anymore?
Well, gold prices have been pretty weak for a few years now. Earlier this year, they hit new all-time lows. And yeah, I think it's because the dollar just has been on an absolute monster run. The Fed's inflation target is 2%, but inflation has been a lot lower than that for a few years now. So we're just not seeing much reason to buy gold as long as the dollar is this high. So gold and the dollar, by the way, tend to move opposite. So that's why the dollar strength is gold's weakness. It's their kryptonite. How about you, Robert? What'd you watch this week?
So this week I was watching Qualcomm. Now, despite revenue falling 17% from the third quarter of last year, their stock rallied to highs they haven't seen in 2 decades. This jump is mostly about the future, as they reported to have inked deals to supply Qualcomm chips to over 200 5G devices. It is expected that over 200 million 5G phones will ship globally in 2020. So, in other words, their chip that they sell at a premium will be put in all 200 million of those phones. So that's good for the future. So despite bad revenue reporting, their stocks are rallying due to the future, not necessarily on current results. So everyone's betting on the future on this one. Now, Activision Blizzard, I actually sat and listened to the quarterly earnings reports on this one as it was happening. So during the call, they reported earnings that were everything that they beat. The stock increased to 56 cents per share before the earnings report. So it was trading at about 56 on midday Thursday before the quarterly earnings report. But so despite beating analyst expectations and setting expectations higher by adjusting their future forecast, it just wasn't enough to impress, and the stock dipped back down to 54. I think there was a lot more optimism in the stock, so analysts were expecting a lot more in terms of what the numbers were there. So that what caused the stock to dip back down to 54 at the close of the week. And CVS, they eclipsed the $70 mark after reporting revenue climbing to 34% year over year. But this is taking into account their acquisition of Aetna, so I'm not really sold on them yet. The trend line that you were talking about earlier, that may be as a result of the Aetna acquisition that they made a year ago. But maybe they got everything cleared out of the way with the Aetna acquisition in terms of getting everything squared away. I did report, I think it was last week, that they finally got through all the litigation on the merger between Aetna and CVS. So maybe the coming weeks will sell me on the stock.
I hear what you're saying, Robert, but I will say we're going to record an education segment later about how to value stocks, how to do valuation on stocks and determine their fair value. So listeners who are interested in that should check that out. And that episode, I'm going to talk a little bit about CVS so that you can see and our listeners can see just how fairly valued, how undervalued, frankly, CVS is right now.
I look forward to listening to that. So Tesla. So apparently I misread the date on this because I said that their quarterly reports were going to be this week. They were actually the week of October 23rd. But despite of that, I'm still going to talk about the report anyways. So prior to the quarterly report earnings, they were low. The expectations were low for their quarterly reports for Tesla. So instead of an expected loss of 46 cents per share, they reported an earnings of $1.86 per share, which is what caused it to jump past that 300 mark I talked about last week. Sprint. So despite having a surprising large subscriber growth, it failed to capitalize on that growth by not being able to cover their losses, causing the stock to dip down near the $6 level. This might be a stock to buy into if it goes below the $6 mark. It hasn't dipped below $5 since late 2016, where it saw the stock soar up to $9 in early 2017. So it might be a good long-term stock to buy in terms of, buy it below 5 and then wait for it to go back up above 6 or 7.
I actually hadn't seen those Tesla numbers. I mean, to go from an expected loss of 46 cents per share to earnings of $1.86, that is an insane earnings beat. I I was not aware that that had happened.
Yeah,
I think that may be, is that the first profit that Tesla has ever reported? Because they've been reporting huge losses for several years now.
yeah, I think it is because as you just said, it's like they've been losing money and hemorrhaging money for the last ever since they've been out. So the fact that they're finally starting to turn a profit was really good news for the company because that means that electric cars are probably going to be the way of the future, as
Yeah,
they
that's
should
one of
be.
the reasons that I haven't owned any Teslas because they have a limited cash reserve, and the way they've been hemorrhaging money, I was afraid they were going to run out of money before they managed to turn a profit.
Yeah, for all the other electric cars that are out there, you usually only see them for like 2 or 3 years before all of a sudden they disappear.
Yeah, that's huge. That's huge.
So
All right, well,
what stocks are you watching this coming week?
I've got. I'm going to continue watching Eros as I mentioned for that breakout above 260, and I've got a small position right now because I was hoping it would go down a little lower and I would be able to buy more. If I get that 260 breakout, then I'll probably buy a bunch more of it. Um, I am going to watch also CVS for any sign of a pullback from that trend line, in which case I will buy more shares of CVS. I actually exited at that trend line. So I got out and now I'm looking for a reentry. I bought a small position when it pulled back just a little bit at the end of the day Friday, and then I'm hoping for more of a pullback so that I can pick up a larger position. Some other ones that I'm watching right now are Athenex, which is a pharmaceutical company, Nektar Therapeutics, and OG Energy. All of these this week were some of the best earnings reports of the week. They all reported very significant earnings beats and also upgrades of their forecast. So Nectar in particular, I made 7% on this week after the earnings report. These are stocks that went the wrong way actually on their earnings report. They dropped despite reporting really good earnings and guidance. So I got in on all of them. I am up on all of them. Nectar, though, in particular, I think has the potential to break out soon. It should go at least to 2130 or so. And if it can get above 2134, then it could break out and move a lot higher very quickly. So I'm kind of excited about Nectar. That's one of the major ones that I'm watching right now. And also, Coda Octopus is an underwater engineering company. They make sonar equipment. They've been in a very long downtrend since last May. Um, and they are, pretty attractively valued right now. They've got a PE of like 10, which is a pretty low PE. And they've reached sort of a critical support level. They're kind of making a rounding bottom. And it looks to me like they've got a lot of upside potential. They're now right at a trend line, a downward trend line. So if they go up on Monday, basically they will have breached that trend line, and that would signal a new bullish future for the stock. So I will enter as soon as Coda Octopus breaches that trend line. Folks who are interested in seeing the trend line can go to tradingview.com and check out my account. I'm Christopher Carroll Smith on tradingview.com. And if you go to the Coda Octopus page, you will see my analysis of Coda Octopus there with the trend line on it. And you can draw your own trend line, set up an alert, and get an alert on your phone as soon as it makes that trend line break. What are you watching, Robert?
So this week I'll be watching a few stocks. Nvidia, they report their earnings on Thursday. They are the chip maker for most of the video processing units that are found in computers, especially for gamers. So this kind of ties in with the Activision Blizzard stock I also watch. They took a major hit last year. Back in April, they were at a high of about close to about 190. And then they dipped down to 135, and I had actually bought into the stock right before the dip. So I've been waiting a long time for it to get back to where it was. So right now it's back over 200. So hopefully with the new processing units set to come out next year, their stock will jump back up to highs. I think their highest is about 280 back in August of 2018. So hoping it gets back up to that level, hopefully higher. So this is one of my long-term stocks, and they're definitely one to watch. Walmart also reports on Thursday. They're still at an all-time high of 119 per share right now. They're expected to beat expectations again this quarter. So again, they're one of the higher hitter stocks just for the fact that they're always almost constantly beating earnings. They've only dipped one major time. That was back in May of 2018. And the only other stock I'll be looking at this week is Viacom. They're also expected to beat expectations. They own Nickelodeon, MTV, Comedy Central. They're expected to post earnings of about 76 cents per share.
Excellent. All right. Well, listeners, if you enjoyed the podcast, please make sure that you give us a like, a comment, or a share on YouTube. Follow us on Facebook and Twitter. You can see the links for that underneath the video. We can also be found on Podbean and the iTunes podcast, Apple Podcast. So go over there and give us a 5-star rating. Let us know how much you like the podcast. And also, if you would like to support the podcast, please use the Webull link underneath the podcast and set up a Webull account. Add $100 to your account. You get a free stock. We get a free stock, and that helps us support the podcast. We're going to have to pay for hosting space at some point because there's a limit how much space we can get for free. And we also would like to do a little bit of Facebook advertising, help get the word out there about the podcast to make this a little more worth our time to do. So your contribution by clicking that link there and helping us out would go a long way. Thanks so much, and we'll see you next week at the zoo.